the best place to start this week is with this question that's come through. Okay, and the question was, what do I think about the short in equities? Okay, whether that's German equities, whether that's US equities, what do I think about the short? Now, the important part about this question, and I don't quite think the member that sent this question, I don't think they quite thought through what they were asking me. Okay, because on one hand, I could make a case, technically why there is no such thing as a short in equities. On the flip side, I could make you a very strong fundamental case why there's only a short in equities. All right, now there's a beautiful lesson that's going to come out of this stream, and ultimately, what it comes down to is it all depends. It's all based on probabilities. Okay. Now, the best way to explain that, right, is if you said to me, okay, let's say you're in the bear camp and you believe global recession's coming and manufacturing is weak as it is, globally. We've obviously got recession in manufacturing, recession in global earnings. So let's say you're in the fundamental camp, okay, and you said to me, well, right now, fundamentally, with Trump, China, all this kind of thing, right now there's a fundamental case for a 10% sell-off in equity, similar to that of last year, given the illiquidity. And you made a case fundamentally for the short in equities, where you could find a logical stop, i.e. you said, well, I'm going to risk, say, a 5% move in the E-mini S&P 500, but it's going to give me exposure to a 10% move in the equities. Okay, I could understand that logic, right? There's a lot of logic behind that. It's relatively sound in terms of the objective facts. Yes, PMIs are in a recession. Yes, we are seeing a recession in global equity earnings. Yes, there are the other sectors that are showing these sorts of recessionary type indications. Okay, so there's logic behind it. It's ground in logic, right? Which means that the odds or the probability, okay, is that there is a potential for a short in equities. Right? Now, let's say you put that number. Let's say you put that number at, you think it's roughly speaking, a 60-70% chance that this theme is likely to occur. Okay, then taking a 2-to-1 risk reward, i.e. where you risk a 5% stop for a 10% move, makes a lot of sense. Okay, there's objectivity in the approach you're taking. Now, I don't think, and this is why I said to you, I don't think the person that sent this through, the member that sent this to me via email, I don't think he quite thought this through in the way I'm kind of going through it. But let's flip it on the other side now. Okay, let's say to ourselves, well, what do we think, what do I think about the technical aspect of a short in equities? Okay, and the simple answer is technically, as we're going to go through in the next couple of slides, if I showed you a chart, right, there is no reason, no justifiable technical reason to be short the equities. Okay, if anything, there's a very strong justification for being long. Okay, and that's the important thing. If there's one sort of lesson you can take from today, right, is that you can be bearish in one set of circumstances and you can be bullish in another. Okay, I might be short-term bearish the gold market now that we've broken below the $1,500 and sustained a close below. I may be short-term bearish, but I'm definitely not medium to long-term bearish. Okay, if anything, gold is still up 12% on the year. So if anything, I'm still long-term bullish gold. Okay. At the end of the day, guys, the objective of a trader is not to be bullish or bearish. It's not to be right or wrong. It's to make money. That is our sole, purpose as, day traders, as speculators. It's to make money. Right? So when you next time read a tweet, when you listen to someone sort of debating a case for a bear, for a bull, for a long or a short, whatever it might be, always listen to the objective facts. Okay, there's one lesson I can teach people, especially younger people. Sorry, let me not younger people necessarily, is younger traders. In other words, sort of traders that are still new to this career, is that pay attention to the facts. It doesn't matter what people's opinions are. It doesn't matter if I think it's bullish or bearish. What matters is what's my justification behind why I'm bullish and bearish. Okay, so let's look at that technical. Sorry about that. Let's just give me one sec. Let's look at that. That case now for the technical aspect. But now, what we're going to talk about today in the stream is ultimately breakout trading. Okay, that's where we're going to go today. We're going to go to this, theme of breakout trading. Now, this is what's been in the market all week. Reflation trades are ascendant. The world is safe. Okay, US PMIs have bottomed. Okay, the whole world has been fixated on this concept of the potential for a recession in 2020. The pricing was that way as well. Okay, so let's look at the facts. At the start of this year, the Fed was still talking about hiking rates. They quickly flip-flopped. Late December, they flip-flopped. They went from, we're going to wind down the balance sheet, to now having cut interest rates 3 times. And also, the balance sheet has now gone up by a cumulative, I think, 60 billion. Okay, so a complete flip-flop. We're 10 months into the year, and we've gone from, wanting to hike rates and normalize policy to cutting rates and expanding the balance sheet again. Okay, now, whether you think that's bullish, bearish, that's irrelevant. I'm not interested in that. I'm giving you the facts. Okay, and that's how we treat the markets as traders. We look at the objective facts. What can we objectify? What's opinion and speculation, and what's fact? Okay, now, reflation trades are ascendant. That's an opinion. Okay, someone believes there's a reflation trade, and the logic behind this is what we've seen in the past week is we've seen bond yields globally start to rise. Okay, US 10-year is now back to 195. Okay, German bonds are negative 22 basis points. Okay, so stop and think about that for a second. Right? German yields are at negative 22 basis points, and US yields are at 1.95%. Now, to put that into perspective, okay, at the hike of the hiking cycle that we saw in late December, the US 10-year was all the way up around 3%. Okay, and German bonds were exactly around this negative 22 basis points. All right. Now, what this author is trying to sort of point toward is that we're starting to see rising yields. Okay, as a result of that, we're obviously seeing equities very buoyant. Okay, the equities are loving this type of scenario where real rates are still relatively low. Okay, so they're still very supportive for equities. Okay, but we are starting to see these yields rise. We're starting to see money move out of risk, in other words, out of bonds, i.e. sell bonds, buy risk. Sell cyclical stocks, buy technical stocks, more, sort of risk, sort of appreciative type trading. Now, why this is important to understand is that if we go look at a chart, okay, this is what we see from the facts. If we go look at a chart, if I showed you this chart, okay, it doesn't matter if you're a 1-minute time frame trader, if you're a 5-minute time frame trader, or you're a daytime trader. Okay, if we look at this chart and we objectify it, now we purely pull out the facts, not what we think it should be, not what Donald Trump, trade war, blah blah blah, none of that. We just objectify. Look at the facts. Right? This 30.32 was our previous record high. We can see the first time it got up there was a significant response. Right? That was in the August sell-off. Okay? Again, that was led by a little bit of concern around the trade wars between China and Trump. There was an escalation of tariffs, as we saw in September, on September the 15th. Okay? Market then consolidated, and we came up for a second time at the end of September to those record highs, 30.32. And again, the market peeled back off. Right? On the flip side, what did we see? We saw a low at 27.32 made back in June. We then saw a higher low made back in August. We then saw another higher low made back in September. We then saw another higher low in October. Okay, all objective facts, not my opinion. These are higher lows. Okay, in other words, we have a higher support mechanism in the market where buyers are buying higher and higher prices. They're not waiting or allowing the market to dip too far. Equally, we see a reluctance of buyers to be too aggressive at a point in time. Okay, not necessarily resistance. You can call it resistance. Nothing wrong with that. There is a resistance of the buyers to be aggressive at this 30.32. Okay, if you want to flip that around and call it something else, sellers are entering. Okay, there's more sellers than buyers. Call it what you want. Okay, the objective case is we're seeing a series of higher lows and we're seeing a reluctance at higher prices. Now, go back to 2 weeks ago, and all of a sudden now we've seen no reluctance to buy higher prices. Okay, we've finally seen the market shift a gear, finally seen the market say, okay, we accept whatever it is in the market. Doesn't matter if it's technicals, doesn't matter if it's fundamentals, doesn't matter if it's Trump or China or Brexit, whatever it might be. The market has said we accept the break above this 30.32. Okay. Now, given this market's been in a sideways range for 4 or 5 months, okay, the fact that we've now accepted this break above 30.32 brings participants into the market. Okay, and those participants are suggesting to us that prices are moving up. All facts, guys. No opinion here. No, I'm bullish, I'm bearish. No fundamental, let me analyze it. Just pure facts. That's all we're doing. We're objectifying what we see in front of us. Now, let's have a look at the volume structure, because this is where more facts can be drawn out. Okay. Notice the first time we made these record highs. Okay, what did the volume structure look like? Relatively low. Okay, market sold off and the volumes picked up. What happened the second time we made this high over here? Okay, markets came up, volume was relatively low. Eventually market sold off. What happened to the volume? It picked up. Third time, what's happened to the volume when you've gone to record highs? Okay, it's gone relatively low. Okay. So what are we seeing here? We're seeing a case of, so long as there's a low amount of volume being transacted, okay, that tells us that the probability for some form of continuation is actually quite high. Okay. Now, what I'm trying to get to is, if we go back to that question that I was asked, what do I think of equities? Well, if I look at this chart, okay, it doesn't matter what time frame it is. If I look at this chart, all I think of equities is that we've now broken above this 30.32. We've got a series of higher lows. We've got volume relative to where it is every single time we've made a new high. For all intents and purposes, we should essentially continue the path of least resistance, which is to the upside. Okay, until we get back below this 32, or we see a sustained pickup, not just one day, a sustained pickup in volume. Okay, I have no interest in selling the market. Not because I'm not bearish, not because I can't make a case for being bearish. Okay, but right now the facts are that buyers want to move prices higher. That's the facts. That's what's coming off of the charts. Okay, so, and the reason I go through this analysis very slowly and methodically and purposefully is because all too often it's very, very tempting. Right? Don't get me wrong, please understand. Okay, I'm not long equities. Okay, I haven't been buying this all the way up. I haven't, sat here and, I'm 50, 60 handles on side and cleaning up on the long side of the market. No ways. Okay, the reason I'm sharing this with you is because I don't want you to be caught in that trap of, oh, there's resistance at 3100, or oh, let's draw a Fibonacci retrace extension, or oh, this is the fourth phase of a I don't know, whatever it might be, or this is a Bollinger Band. Don't get caught up not seeing the facts for what they are. Okay, now I never, please understand, I never want to slate any technical indicator. Okay, every technical indicator can serve a purpose. Right? As you can see, I've got a few technical indicators on here that most of you won't necessarily know what I'm trying to do, but they're there to serve a purpose. Okay, so what I want you just to understand is, don't be tempted to lean on those indicators before you've leaned on the raw, basic, objective information. Okay, which is that this is a market moving higher. We can see that with the higher lows. This is a market that is exhibiting low volume as prices moves up. This is a market that's exhibiting, when we see a sustained pickup in volume, prices tend to move lower. Okay, that's what we want to draw. Those are the conclusions we want to take away from this market at this current point in time. Okay, so that's the crux of it. What do I think of equities? Now, where I want to kind of just sort of summarize this, right? And again, it just sort of drives home. It's these questions you need to be able to answer. It doesn't matter the market, the time frame. Okay, whenever you assess the market, say to yourself, well, what is the path of least resistance? Okay, now if I showed you this chart, anyone that's in an objective state that just has a complete blank slate, almost a blank page, if I showed you this chart, you would say to me, yes, the path of least resistance is to the upside. Okay. Now that doesn't mean, guys, that doesn't mean later on this afternoon, on the 12th of November, that doesn't mean we don't see a 10% correction. Okay, of course that can happen. There's every probability that that could occur. Okay, but what we always have to sort of determine as traders is right now in the short term. Okay, and short term could mean one day to some people, it could mean a couple of days, a couple of weeks. Okay, but right now the current information is suggestive of prices to move higher. Okay, so the path of least resistance is to the upside for now. Okay, we are at record highs. Guys, we've never been here. That's an important thing to stress, is that we have never ever been trading at these prices in history. Okay, so how can anyone justify a technical reason as to why there is some form of resistance up here? We've never been here. Okay, the market is in price discovery mode. It could price discover another 10%, 20%, 100%. We don't know. Okay, if you want a good example, and it's, well, not necessarily a good example, if you want an example, go look at Bitcoin. I remember a lot of people going, when we got to 12,000 the first time, everyone going, oh yeah, no, it's overbought. And then it got to 14,000, everyone was like, well, no, this is a bubble now. And then it got to 15,000, and it was definitely a bubble. And then 16,000, 17,000, 18,000, 19,000, where do you want to stop? Okay, perfect example is that there's no point in fighting a market that's in price discovery mode because we don't know where it'll stop. There's no point in wanting to sell a market that is in price discovery mode. Why? Because the ship takes time to turn. And this is a wonderful expression. I learned this actually sort of, I think it was about 3-4 years ago. And where it came from was, like, I mean, if you've been following me for a while, you know, I've always been very, very bad at breakouts. Okay, I struggle a lot to hop onto breakouts. Hence, this is probably quite a fitting stream. But the one lesson I learned is that when a market does exhibit a large time frame breakout, large time frame meaning big influential participants, okay, not day traders, not algorithms, not the guys on Twitter. Those are not large time frame participants. Okay, large time frame participants don't exist on Twitter. Okay, so when you read Twitter, take everything with a pinch of salt, just by the way. But large time frame are your institutions, your hedge funds, your big people that can move the market substantially one way or the other. Now, the most important thing to understand is that when a market is in price discovery mode, it takes time for the ship to turn. In other words, you're not going to see something like this where a market's moving higher, and all of a sudden the market just jumps off a cliff. It doesn't work like that. Okay. What eventually happens when markets top out or turn around is they form almost like a accumulation pattern where you get a lot of two-way trade, maybe one last little pop, and then the markets roll back over. Okay, so let the ship take its time to turn. I see it so often where traders go, I'm bearish and it's going to collapse and recession and there's so much opportunity. Well, guess what? Okay, if you just bide your time, right, and you don't rush into it, the market will show you the technical opportunity. Okay, like I said to you, 30.36 right, is where all the positioning is now locked in. In other words, the market's bullish. So long as we're above 30.36, we get below there, there's a lot of longs that are going to come under significant pressure, both in the short term and the long term. Okay, so you don't need to rush. You don't need to get the best price in the market. What you need to be aware of is where the market is, what the most likely path of least resistance is, and where the risk-reward opportunities are. Okay, as I said, positioning is key. Right now, above 30.36, the market is long. The positioning is long. Okay, there's very few shorts in the market. Why? Because why would you be short a market that's never been to these prices? Okay, yes, there will be some people that are shorting the market, some people with big balance sheets. Right? Let them be short the market. They can afford to see a market move 5, 6, 7% against them. Right? Most of you that follow this, most of the members of Axia, right, you technically shouldn't be going 4, 5, 6% offside. Right? That's a lazy way of trading. Okay. Then a lovely little expression: go with the flow or die by the death of 1,000 cuts. Okay. If you choose to go against this, if you choose to stay in a bear camp, okay, you have to acknowledge, and this is where self-reflection is so important. You have to acknowledge that you are counter the trend. You are counter where the majority of people see price going, not where I see price going. The majority. Okay, and the reason we can justifiably say that as a fact is that prices are moving higher. Okay, so choose: go with the flow or die by a death of 1,000 cuts. Okay, for me, it's far easier to go with the flow or stay the heck out. Okay, if you that sort of, deep down sort of fixated on that. It's bearish and it's going to go down. Okay, that's fine. There's nothing wrong with having that really strong bias. But just be aware it can be a slow, painful death. Okay, let the technicals guide you. Once those flows turn, once the bearish flows start to come in, by all means, then go short. Okay, because then you're going with the flow of the market. And then the summary, I think this is really the, if someone was to ask me, how do I summarize this entire stream? Be objective. Okay, the Financial Times is not objective. The Bloomberg is not objective. Trust me, I listen to these people every single day on the television. Okay, they are not objective. They are speaking their books. They are speaking their positions in the market that they desperately want you to get onto. Okay, look at the facts. Pay attention to the facts. The facts can't be as easily manipulated as opinions. Okay, and I say that as easily manipulated because yes, statistics can be inflated or deflated. Just look at the example of China. Okay, so be objective. Be objective not just in your interpretations, but in your understanding of the market. If you do that, okay, you'll have a much better clarity and understanding of the market, rather than this, I think it's going to go down, blah, 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 blah. Okay, so hopefully that answers your question. Again, it wasn't a silly question. Please understand me. I mean, I might have muttered under my breath, that's a silly question to ask me what I think of equities. But there's a good lesson to take away from that. It doesn't matter what I think. Okay, it matters how I objectify whether I think it's a buy or a sell. The objectivity, is ultimately what it's all about. Okay, so there's a little base case example for you guys, and particularly for the members. Go away and as an example, get an A4 piece of paper, pick a market, doesn't matter which market it is. Preferably pick a market you don't know anything about. Okay, something you don't know the fundamentals about, because that way you won't be sucked into, I think this, think that. Okay, and go and write down on that piece of paper, technically, what are all the objective facts that you can observe? Not what does my indicator say it should do, but the objective facts. Okay, go and highlight those objective facts, and then go and look and say to yourself, okay, if I just observe the market like this going forward, what is that going to do with my understanding? What is that going to do with my end results? Okay, there's an example for you. Go away and practice that. Okay, objectification is extremely, extremely pivotal in the long run of your development as a trader.